Welcome, everybody. Welcome to the Shaping the Post-Pandemic World, the India-focused webinar series at the Schulich School of Business, York University in Toronto, York University online. So welcome, look forward to the next 90 minutes. The topic for today's discussion is how global funds are responding to the pandemic, the Cdpq experience. Very quickly, here's the flow for today. I'm going to tell you about what it is that attracts Schulich to the topic of infrastructure. As you will see in a moment, we've got a lot of depth and experience in that particular space. I'm going to take a minute to introduce a very special guest, a Schulich alum, Deepak Anand, who's also a member of Provincial Parliament. I'm going to introduce one of our two featured guests, Professor Pauline Chum Nolan, and then quickly we'll introduce Rontu Basu, who is my co-host for the event. Rontu will then introduce Victor Thomas, another special guest. And then Rontu will introduce our featured panelist, Anita George. We will do all this very quickly, I assure you. And then we will go into the main act, which is presentations and discussions between Anita George and Pauline Chum Nolan. We will close with a question, a generative discussion question by Victor Thomas, and then we will open it up to general discussion. In all of this, I encourage you to use the chat window, to populate the chat window with questions. We will draw from those to pose them to the panelists. So Schulich, a world leader in infrastructure education. There's 3 points I wish to make very quickly. We have a center of excellence at the Schulich School of Business called the Brookfield Center in Real Estate and Infrastructure. Its founder, I'm not sure if he's on the call today or not, is Professor James McKellar, a force of nature, if you know him. He has been at the forefront of real estate and infrastructure education for well over 3 decades. He came to us from MIT in 1995 and has really put Schulich on the map in this space. We're deeply grateful to James for the work. And indeed, over the years, James has assembled an absolutely fabulous team in this place, comprising his partner in crime, Andre Kuzmicki, and then more recently, faculty including Avis Devine, Jim Clayton, and Sharina Hussain. I will put up the link to the Brookfield Center in the chat window for people who are interested to look it up and see the fantastic things that we do. Schulich also offers 2 degree programs in real estate and infrastructure, a master's, an 11-month master's program, and a 2-year MBA, the second year of which you can specialize in real estate and infrastructure. I'm going to post those links as well. And most interestingly and excitingly, over the last 2 years, Schulich has pioneered the Sustainable Infrastructure Fellowship Program. So we will talk a bit more about that as well. The substance of the program is it brings together government leaders from the developing world and engages them in conversations about developing sustainable infrastructure in the developing world. They had 15 students, and these are fully funded programs, mind you, 15 students last year and about 27 that they will be doing this year, next year online, given the circumstances this year. But we look forward to welcoming them to the physical classroom once we're past the COVID crisis. So fantastic depth in the infrastructure space at the Schulich School of Business across these 3 elements. Featured a guest of honor today, someone I'd like to acknowledge because he's been such an active champion of Schulich and its initiatives, is Mr. Deepak Anand, who's member of Provincial Parliament. Deepak is a Schulich alumnus. He's an MBA from the Schulich School of Business. He's a member of Provincial Parliament from Mississauga, Malton. The particular role of interest, he serves in a number of parliamentary roles, but one of the key role of interest for today's conversation he is special advisor to Minister Vic Fedeli on the India-Ontario trade file. So if Deepak, you get a chance, if you're able to stay on for this and you get a chance to pose some questions, we would love to hear from you. Welcome. The first of our 2 featured panelists Dr. Pauline Chum Nolan. What can I say about her? One of my favorite colleagues at the Schulich School of Business. She is an accomplished scholar, has published in the pinnacle journals of the discipline, like the Journal of Finance. But what's also interesting about her is that she's able to use finance theory and apply them across a range of contexts. Her work, for example, in the art world and investing in art and using finance theory to understand that, I find particularly fascinating. It is no surprise that she's a winner of numerous research and merit awards at the Schulich School of Business, and she's also a recognized accomplished scholar. She's cited by a number of media, including the Wall Street Journal, the Canadian Business, the Globe and Mail. The Globe and Mail, as I recall, 2-3 years ago, had a photo feature of Pauline that was, I thought, particularly impressive and laudatory. So it's always wonderful to see an academic colleague being celebrated in the larger world. So that's Pauline as a scholar. Pauline as an administrator, actually, the first time I met Pauline was as an administrator. She was in her capacity as director of the PhD program at the Schulich School of Business. I have not met a more ardent champion of the PhD program, a more committed administrator, and someone more committed to the development of the school generally than Pauline Chum Nolan. Pauline has also been founding director of the Master of Finance program that has grown by leaps and bounds over the last few years. So as a colleague, Pauline, thank you so much for all of the work that you've done at the Schulich School of Business. The last aspect, if you will, of Pauline that I'd like to acknowledge is that not only is she an accomplished scholar and administrator, but she's also an active participant. She's an active practitioner. Pauline is CEO, co-founder of wealthscope.ca, and its a unique kind of angle, if you will, is that it uses data and technology to build investment portfolios for individuals and for enterprises. So I certainly encourage you to look at that. In short, a kind of a wonderful blend of research and kind of engagement with the real world today. So we're really, really honored and excited to have Dr. Pauline Chum Nolan on board, and we will be turning the floor over to her very, very shortly. But before we go there, I'd like to introduce my co-host, Rontu Basu. Two things. Rontu is a senior banking executive with immense experience. But more to the point here, Rontu has had a very active connection with the Schulich School of Business over 15 years now. His co-founder, Mr. Imran Panju, and Rontu, they run a company called Quest Partners, and they have been absolutely pivotal, instrumental in developing Schulich's presence in India over the last 15 years. So as an institution, we've been deeply grateful to Rontu and Imran, Quest, the co-founders of Quest Partners, for the incredible service that they've rendered to the Schulich School of Business. Look forward to hearing from you today, Rontu. And with that, I turn the floor over now to Rontu Basu. Over to you, Rontu.
Thank you, Ashwin. My pleasure to introduce the young and dashing new president and CEO of the Canada-India Business Council, Victor Thomas. Victor is based in Toronto, and he recently took up the job in April of this year. I've known Victor since his days at the Asia Pacific Foundation, and he's recognized as a business leader with a wealth of experience in trade, corporate governance, and international strategy. Victor also has a deep network in the public policy space and has traveled to India numerous times with business delegations and has been active participant in various CIBC and ICBC forums. So welcome, Victor. Victor, we will loop in later in the session. He'll come back with his comments on the subject and questions to the panelists. If I can now move on, and it's my great privilege to introduce Anita George, our main speaker for today from Cdpq. I've known Anita since, I think, 2017 through our association with the Indo-Canadian Business Chamber, where we are fellow board members. What has struck me about Anita over the years that I've known her is her calm, reassuring, and confident demeanor, qualities, no doubt, that leaders need to display as they navigate their organizations through the pandemic. Recently, as part of Cdpq's globalization strategy, a new structure for international activities was set up, and Anita has got a significantly enhanced role in this new structure as the Deputy Head Cdpq Global. So congratulations, Anita. Cdpq, just to give you a very brief background, has increased its international exposure by over 140 billion in the last 5 years. And in India, under Anita's able leadership, the book size is around 6 billion US currently. And it has investments across logistics, healthcare, and financial services. Anita has been particularly astute in her choice of high quality partners in India as reflected in their portfolio. Just to give you a few examples, Mahindra and Mahindra, the Piramal Group, HDFC, Kotak Mahindra Bank, just to name a few of the partners Cdpq has chosen in their journey into India. So welcome, Anita, and I invite you now to make your opening comments.
Welcome, Anita. I'm going to turn the floor over to you and look forward to hearing from you.
Thank you very much. Thank you, Rontu, for that generous introduction. And thank you very much, Ashwin, and to the whole Schulich School of Business team. It's truly an honor for me to be here at this webinar, and in particular to share the panel with Professor Pauline, Chum, Nolan. I was actually doing a little bit research on your work, Professor, and it really fits in with the philosophy that Cdpq has been following in terms of the links between the financial sector and the real sector, the work that you've done on entrepreneurship, as well as all your work on pension funds, which is very interesting. I also wanted specially to mention that Cdpq has a very close tie with the Schulich School of Business. We are partners in a broader partnership of investors across the globe, long-term investors like ourselves. We call ourselves the Investor Leadership Network, and it includes most of the Canadian pension funds, including OMERS. So I'm very glad to see that Michael Roland is part of our audience, also CPPIB and OTPP and others. And our aim is really to focus on those things that are important for us as a long-term investor and also important for the world at large. So one of these areas is the Infrastructure Fellowship, where we work in partnership with Schulich, and I have heard a lot of praise from our side of the ILN group who have been working with Schulich as to how adept you have been in really responding to the COVID crisis and the fact that we cannot have the face-to-face interactions that we are also used to. So really thank you very much for that partnership, and we see that growing. In addition to infrastructure, the other two areas just to mention, one is climate change, which is core for Cdpq, something that we believe in. And the other is diversity and inclusion, also very important and something that Cdpq tries to follow in every aspect of our investment philosophy and approach. I think before I go on, I just wanted to give you a little bit of a background of myself. I have worked in the field of infrastructure for almost 22 years as part of the World Bank Group. And my last post at the World Bank was heading the energy, mining, and natural resources sector for the group as a whole. And one of the things that you realize that no matter which country, whether the most developed or the least developed, infrastructure is essential and very much required. And the close link to GDP, to job creation, to improving the quality of life we really don't have to spend too much time on that because it's very evident, and historically there is a close correlation. So just to respond to the questions that were posed to me, as Rontu mentioned, Cdpq has about 6.7 billion Canadian invested in India. We opened our office in 2016. And one of the approaches that Cdpq has made in our growth markets strategy has been to really have feet on the ground. So we have set up offices in India, in Shanghai, in Singapore, which is our hub, in Mexico and Sao Paulo. And through these offices and our local teams, we have been able to build our business. So our AUM, we had about 5% invested in growth markets back in 2013. And today we are at about 15%. So a significant increase. And as Rontu mentioned, in our new avatar of really Cdpq Global, what we would like to do is to create the same kind of synergies across different geographies and looking at our partners and the partnerships we develop in a global context than in compartmentalized context. So this is very exciting and something that we are looking forward to. And somebody who you know very well at Schulich, Marc-André Blanchard, who was Canada's ambassador to the UN till very recently, is going to be heading Cdpq Mondial. And we're very, very proud that he is going to spend the next several years with us. Just looking at the sectors coming back to India that we've invested in is in financial services, logistics, real estate, infrastructure, particularly in renewables. And this fits in very much with our climate change commitments, healthcare, and tech-enabled services. And much of our investment is direct. However, wherever we have, we would like to reach a wider swath of companies like mid-cap companies, entrepreneurial, smaller companies, SMEs. We have actually worked through funds. So we are also LP significantly in different funds, Kedara Capital, Chris Capital, and Fundamentum. Fundamentum is actually a very exciting opportunity for us. In some ways where we broke the typical investment mold, where we joined up with a first-time fund sponsored by none other than Nandan Nilekani and Sanjeev Agarwal, both very, very experienced in the tech-enabled world. And we've actually been able to learn a lot through this fund and made our first tech-enabled investment in the healthcare sector prior to COVID. And of course, it's been one of those sectors that has really done well. And it's a sector that we would like to continue working on in India. Should I continue covering the other questions, or would you?
Yeah, absolutely. If you could take a couple more of those, and then we can turn to open the floor up for discussion, if you don't mind.
Sure, sure. So one of the questions I've been asked is the challenges of doing business in India. And I should say that as Cdpq in India, we've always represented Canadian pension funds in addition to representing Cdpq. So the first thing that we did is, as our exposure in India was growing, we had a lot of questions from our fellow pension funds in terms of our approach, our philosophy, what we found in different sectors, how we got comfortable taking certain risks. And this is not just limited to Canadian pension funds. We've also had a lot of interactions with Australian, UK, and US pension funds as well. And you will be happy to know that in the last 5 years, collectively, the pension funds, as well as some of the long-term funds like Brookfield, we have invested $50 billion in India across several sectors. And this is something which doesn't get counted in the trade flows between India and Canada. So I am always saying to our Canadian High Commissioner, Nadir Patel, that he should really present this 50 billion because A, it's long-term capital, B, it's really well suited for sectors like infrastructure and real estate, very much needed. And the bulk of it is towards equity, which is even more difficult to come by than debt financing. We also have been pioneers in many of the sectors, bringing in new business models as well. So this is something I think which we have shared. Now, on the challenges of doing business in India, one is, of course, common to all emerging markets, which is the business cycles and the volatility. In fact, one of our Indian partners told us, if you're investing in emerging markets, you have to think of it like a Bollywood movie. There will be lots of drama, but it has often a happy ending, and that's what you have to look forward to. So I think the volatility and the business cycles is something that we have to take into account even in the beginning while we are evaluating our investment. We also see specific to India a lot of evolving regulations. So when we did our first investment in stressed assets, the Indian bankruptcy code was just on the anvil and it came out, then the regulations followed, and then the actual practice. And since these are pretty major regulatory changes which kind of shape the usual business as usual models, you can anticipate that there will be pushback, there will be back and forth on the interpretation of such regulations. But I'm very happy to report that the IBC is now something that we as long-term investors are comfortable with. And I think the government and the courts have done right by making sure that what was the intent of the IBC is actually kept so in spirit of execution. The second big one is the GST, and this is something that Canada is also familiar with because you have implemented and you know how difficult it is when you have a federal system to get all the states to come together and agree to approach to GST and to the different levels of GST. This is, I would say, still work in progress, but definitely from a medium to long-term perspective, something very good that India has done. Then there is the Real Estate Restructuring Act, and so on and so forth. So what I would say is that the regulations that have come out, they are new and therefore take some time in terms of the interpretation and the application of the regulation. So this can sometimes cause some heartburn and anxiety to investors. But I think if you have the long-term perspective, I would say that all of these regulatory changes are for the good and therefore welcome. Something else I should mention, and normally I am not one to hold the flag for governments in general, but I have to say that a big change I see in India is the government proactively seeking us out to get our feedback individually and collectively as Canadian pension funds on the ease of doing business in India, on the taxation framework in India, on different regulatory aspects. And we've had ample opportunity, including on the IBC and RERA, to give valuable feedback. And most important, the government has actually heard us. And one of the most recent achievements, which involved the ICBC, the Indian Chamber of Commerce, as well as the high commissions, both in India from Canada and in Canada from India, as well as many of the regulators. The pension funds have achieved getting tax exemption on all infrastructure, debt and equity investments, as well as other sectors like healthcare, logistics, which fall into the definition of infrastructure. This is very big because it makes India comparatively more competitive as capital finds its way, when we can see that the about 150 to 200 basis points that was on account of taxation gets to the benefit of the investor, and by in turn to the investment activities that we do. That's a big, big plus. And this has happened in the last 2 years. It's something that we in Cdpq are very proud of, because we led the charge, if I could say that. But what helped us, that we were able to get OMAs, OTPP, CPPIB, all of us together in a room, and collectively we made the representation to the Indian government, and that really paid off. How has Cdpq fared in India during the pandemic? That was another question you had asked. So first, of course, our attention was on employee safety. And I have to say that it's at times like this that a culture of the organization comes to the fore. And I'm hugely proud of Cdpq that before doing anything else, even though our portfolio was going through a roller coaster and many other different crises that we had to handle, the focus of the organization first and foremost was on the safety of our employees, making sure that they could work from home. And it has truly been an amazing endeavor. We did some pulse surveys, and all of our employees, I would say somewhere in the 97, 98% have responded positively and have recognized the value of how Cdpq has looked out for its employees. Second, of course, we have looked at our portfolio and the safety of our portfolio, because our pensioners depend on our performance, and that is something that we have to really pay attention to. So we have done a tooth comb analysis of our entire portfolio globally, and sort of put firms in different categories: those that are really under stress and may need urgent, immediate help; those that will face challenges, so need some hand-holding through the next 2 years; and those that have actually benefited and are growing because of the impact of COVID, areas like healthcare, tech-enabled services, etc. In terms of plans for the immediate future, I would say that we are actually, as a long-term investor, able to take advantage of some of the opportunities that have been presented, like correction in valuation. And one of the challenges of doing business, particularly in India, is that the valuations tend to be relatively higher than in many other markets. And so for like to like, if you compare, let's say, a bank in India to a similar bank in Canada, the valuations are sometimes 3 to 4 times what it is in Canada. So one had to do a lot of work to focus on how do we value growth, and how do we understand these high valuations in higher risk markets. So that's a challenge that we continuously face. But I think through the partners that we've picked, through their resilience and their growth track record, we have been able to show how these companies, even while being valued at higher valuations, will deliver value to us over the long run. So these sharp market corrections are actually opportunities for us to come in and make sure that the investments that we make for our pensioners will yield the kind of higher returns once adjusted for the higher risk. So I would say all in all that CDPQ's perspective is not just a long-term perspective, but one which revolves around partnership. So we have stood by our existing partners. We have actually come forward even when the market has been under pressure to support them. We also have made sure that our investments are sustainable. And as I mentioned earlier, sustainability for CDPQ is at the core of our investment thesis. We have committed to reducing our emissions by 25% by 2025, and also increasing our green investments by 80% by the end of this calendar year. And we're well on track to achieve that. Not only that, something very interesting which hasn't been talked about a lot, but every single one of us have a carbon factor. So if we meet our targets on sustainability, we will get whatever we were owed in terms of a bonus. If we fall short of it, then we're actually penalized through this carbon factor. So right to the junior most analyst, everyone is conscious that we have to make the right choice of investments which are sustainable and which are green and which contribute to the growth of the economy. And this is true across the globe, whether it's emerging markets, whether it's developed markets. This philosophy of sustainability is really front and center. And CDPQ again took a leadership role in committing the net zero alliance, where we've again joined with many of our peers to commit that by 2050 we will be net zero. So I think I'll stop because I've taken a lot of time. I hope I answered all your questions. Thank you.
Thank you so much, Anita. And we're going to have opportunity to revisit many of these questions. There are already questions in the Q&A window around this, so we will be touching base with you momentarily about these. Before we do that, I'd like to turn the floor over to Professor Chum Nolan for her commentary on what she's heard and to put the CDPQ India experience in a larger context in terms of what global pension funds are doing. Over to you, Pauline.
Great, thank you very much. Thank you for having me in this webinar, and it's my pleasure to be in the company of such distinguished guests, and want to Ashwin, Deepak, Anita, Victor, and all of you in the audience. So I would like to start just to say a little bit about my experience in the pension field. I have been part of the team, the investment committee for the York University Pension Fund for almost 16 years. So as you can imagine, in terms of the timeline, it has been an extremely eventful 16 years. And the fund has changed a lot. So we've experienced a lot. We've changed strategies along the way. So part of what I'm about to speak on would be based on my personal experience on the investment committee of the York University Pension Fund. And I am here also to speak, I guess, from the perspective of the smaller pension plans. The CDPQ, CPPIB, they're on the world stage in terms of their size. So I think, so I, from my experience, would be speaking sort of my peers would be the funds that are less than $50 billion that we don't have typically funds of that size. We don't have a lot of direct investments. So we relied on being able to find very good portfolio managers to execute our strategies. So I would just like to say that, Ashwin is a plan member. So we are a smaller plan, which is a few $1 billion, but according to financial consultant, for example, Willis, Watson's Towers, we're ranked #1 in Canada for DB plans in 5-year as well as 10-year performance. So we're happy about that. Often matching, if not beating the performance of the bigger plans such as CBBIB. So we're very proud of that. In terms of the response, one of my first questions that I've been given is sort of the response of pension plans. Again, speaking on behalf of plans that are less than $50 billion, where again, a lot of the management of the actual, sorry, I've been asked to start my video. Okay. Is about sort of response. And so I have to say that for, a lot of the results are just coming in. So for example, for Q2 2020, the results are just coming in. So, and, think about the declaration of the pandemic. It's been less than 6 months. So I would have to say that for a lot of plans to still a bit of a wait and see approach to see where our funding ratio is. For example, how, that means how much of our liabilities are being funded by our assets, because there are provincial regulations in terms of the target that we have to meet in terms of our funding ratios. So I think, a lot of it is still a wait and see approach, but more importantly, as you know, for pension plans, we have, as Anita has mentioned, our goal is for the long term. So hopefully, a lot of plans, we've learned a lot from the financial crisis of 2008. So a lot of you would know the CPPIB, for example, they did not. And for CASE, a lot of the Canadian pension plan, we didn't start investing actively until the 2000s. If you look at a lot of the big plans in the 1990s, for example, most of the investments were still in government bonds. So the transition, a lot of it has taken place in the 2000s. And so the big crisis that we had in the 2000 was the financial crisis. So that's when a lot of us then really, dug deep and looked to really strategizing to see how we could better protect downside risk, right? And so I don't know if there are any of you in the audience that have taken my investments course. This is a big theme of mine about downside. So having been on the pension plan for 16 years, I've never had a plan member complain about upside risk, that we have returns above our target, but, we have a 6% target, 1 year is 8%, another year is 10%, another year is 7%. So there's a lot of volatility on the upside, but no one complains about that, right? So it's really the downside risk that not only as human beings, as sort of a behavioral bias, but also as a pension plan, because we have these liability commitments. So hopefully a lot of us have learned from, and really have put together a strategy, that a portfolio that has good downside risk protection. So therefore, I don't think anyone is jumping to really change up the portfolio just yet. And so, but I think this is a really good time, however, to, we were just about to go into a Q2 meeting at York University, for example, is tomorrow. This is a great time for us to evaluate and to see whether or not the strategy that we've put together is working or not. But obviously, it always seems that when there's a crisis, this time is never the same. So for example, in terms of downside risk, in equities, which is a big part of a lot of plans portfolio, there's been a big push and there's been a lot of adoption of going into low volatility strategies. So York University likewise have also invested a big portion of our equities portfolio, the public equities, into low volatility strategies. But of course, this time was different because this time, if you look at the pandemic, if any of your equity portfolio managers did not have technology, which tends to be the higher volatility stocks, for example, if they didn't have Tesla, they didn't have Zoom, they didn't have Amazon, they didn't have Apple, they didn't do well. So low volatility didn't really work this time to protect the downside, because it was what held up was not the low volatility stocks. Traditionally, it's technology. So every time, we learn so much. And so this is, again, a lot of sort of soul searching about, what is sort of the new normal? Has anything changed? Do we need to do anything? So I think for infrastructure, I think it's a big theme of this webinar. And so, if you look at our experience and real assets, a lot of plans have moved to real assets such as infrastructure. So York University was one of the first public pension plan to go into infrastructure. We did that in 2007. So we've had 13 years of experience investing in infrastructure. That said, not direct investment, because we don't have, unlike Cdpq, we don't have the size to do direct investment. So we've learned a lot on that, but in terms of diversification, that was the key, to have these real assets, right, to diversify the portfolio. But obviously, commercial real estate didn't do well in the pandemic. A lot of infrastructure in terms of airport, transportation, that area didn't do well in the pandemic. But again, our goal is long term, right? So I think that we didn't need to panic. In terms of my, again, I have to elaborate later on any of these points that I raised. In terms of opportunities, I think that the pandemic in particular has brought social issues to the forefront, a big spotlight on social issues, as well as corporate governance in terms of how we're treating our employees and our supply chain during the pandemic. Because if you think about responsible investing, ESG, a lot of the focus of a lot of funds has been on the E, right, environmental. But I think what the pandemic has done is to put, as I mentioned, some of the S and the G into the fore. And I think that will continue to be a major theme, in this new decade for pension investing. So I'll stop here.
Thank you. Thank you so much, Pauline. I was wondering, Rontu, with your permission, if we could take up some of the questions before we turn the floor over to Victor. Are you comfortable with that? Okay, great, thanks. So there are a few questions that have popped up. The first one, Anita, is from Sanjeev from Scotiabank, and Sanjeev simply says, "Great work indeed by Cdpq across various sectors in India." Now the question, what are the key risk factors that pension funds such as Cdpq see in the India portfolio?
Thank you very much, Sanjeev. I think, let me point out three big ones. So one, of course, in times of volatility, and the pandemic, as someone said, is a combination of the global financial crisis and the Great Depression. So it's something that we haven't seen before, and it's still ongoing as we see second and third waves. So India is no exception. We see that the growth in terms of COVID cases, the impact on economic activity, etc., there's still a lot of unknowns as we look forward. So I would say one of the immediate risks for us is really being watchful of our portfolio, how they are performing. And I want to highlight also the points that Professor Chum made in terms of the social and governance. And here's why we feel so strongly that picking the right partners is absolutely critical, because it's in times like these that you see the kind of partners you pick and the impact they have. So all of the partners, some of whom Rontu named, have been really going out of their way, and so has Cdpq, working with them. So we have supplied ventilators in Brazil, meals for migrant workers in India, and similarly PPE kits in Mexico, and so on and so forth. In addition, given a dual mandate of also contributing to the development of Quebec, we've worked with SMEs. We have a line of $4 billion focused and targeted on helping companies that are coming out of the COVID. So I would say, Sanjeev, the first immediate in-our-face risk is really the impact of COVID and how our partners and our investments will respond to, and that's still, I would say, some of it is known, but a lot of it is yet to be figured out. The second area, and this is generic, independent of COVID, as in many emerging markets, the exchange risk is something that we have to be very watchful of, because our equity investments are being made in Canadian dollars, and obviously we are looking for returns in Canadian dollars. So the way in which we build our portfolio, the portfolio construction itself, pays a lot of attention to the kind of currency risk that we are taking. And since 2/3 of our portfolio now is outside of Canada, we need to take into account a large number of currencies where we have significant exposure, and how we look at our investments such that we take into account the expected currency changes as well. And here again, this is not a science, but really a science and an art and experience thrown in. So it calls for many judgment calls that we have to make. The third risk, I would say, is coming back to the point of social. So already, when we look at the big picture of many of the countries that we operate in, issues like income inequality, the fact that a lot of people who were sustaining themselves have now, because of the pandemic, fallen into the below poverty line. All of these factors means that we cannot continue business as usual and be in a kind of bubble and just worry about our investments. We have to look at the social impact. And here again, I come back to the importance of the partners we've picked, because we see that they share our philosophy, and there's a lot of time and effort being spent on the social, the governance, in addition to the E. So I don't know, Sanjeev, if I answered your question, but I think it's a combination of financial, but also broader ESG type risks and governance risks that we have to keep in mind.
Lovely, thank you. One comment before I turn the floor over to Rontu, and this is from Mr. Subrata Mitra. Very constructive talk by Anita George. I used to have many interactions with Cdpq when I was active in ICBC as founder director of Birla Sun Life in India. Wow. Good to note, great progress made by Cdpq since then. Best wishes. So I will make sure that the two of you connect later as well. But thank you, Mr. Mitra, for being on the call and for your very kind comment. Over to you, Rontu.
Yeah, so before I just turn it over to Victor, just a quick question from Dr. Raghunathan. He has a question. The pandemic has seen some notable negative beta companies like Zoom, for example. Have the investments of pension funds taken note of such companies in their investment strategies? Maybe Pauline, you can have a go at that one.
So negative beta, low beta, low and then going negative definitely has been a big theme. So low volatility could be low standard deviation or low beta stocks. And so, but however, I think a lot of the managers, if you look, they hadn't, it is sort of not sort of the single stock, that they have. It's how you put together the portfolio. Sometimes, you have a lot of what you think for individual names that fit your investment thesis, but when you put the portfolio together, the way they interact with each other, the outcome might be a little bit different. So, but I think that, for each portfolio, again, so from York University perspective, and again, a lot of the pension plans that are below 50 billion, where they are outsourcing a lot of the equity management to professional portfolio managers. It is something that would be dependent on the specific portfolio managers, but it is something that we monitor very closely. And then in the case of Zoom, for example, again, we just have to still see how once the pandemic, sort of dies down a bit, what is the new normal? And same with, I think there's another question, if I may sort of just quickly address, because it's related. It's in terms of, what about segments that are, that typically do more face-to-face kind of business? And that's something that we're seeing, that in financial services, we have in Canada big incumbents in financial services, and they are very well known to be slow to adjust. But what this pandemic has done is that now they really have to speed up the digital transformation, because it can't just be talk. That digital transformation is a nice phrase to have, but now they actually have to do it. So they're evolving as well. So again, I think it's still maybe a little bit too early to see what the sort of medium-term impacts they would have.
Thank you, Pauline. So I think let's turn it over to Victor. Victor, I think you're jumping out of your chair to ask a few questions. Victor, your comments and your questions.
Sure. First of all, thank you, Rantu. Thank you, Ashwin, and thank you, Theo. The Canada-India Business Council has been really fortunate to get to collaborate with you on these focus sessions in regards to India, and a lot of our members are on and have been on all of them. So first of all, huge thanks. Anita, your comments in terms of the pension funds from Canada being almost a strong silent leader in terms of the relationship. And that's something we want to be highlighting. Many of those funds are our members, but from coast to coast, our largest and most sophisticated investors are, investing in India. And my question is, given the latest quarter precipitous drop, given the shutdown of essentially of India for the 2 months, in a post-pandemic world, a lot of the investments have traditionally been in real estate and infrastructure. In post-pandemic, where do you actually see the opportunities?
Thank you, Victor. I would say that post-pandemic, and we're still not out of it. So as I said, there's a sort of caveat to what I'm saying, but I think infrastructure and real estate will continue to be important, and specifically for India for the following reasons. So as I just mentioned, for infrastructure, all of us pension funds collectively have been given the tax-free status to invest in infrastructure. And the argument we made to the Indian government was that pension funds have ideally suited type of funding for infrastructure. We are long-term investors, and we can come in and hold an asset for 25 years, 30 years, and contribute to the growth of that business. However, what was happening in India, firstly, because of earlier high corporate taxes, a dividend distribution tax on top of that, and the fact that many countries, and actually many developed countries, have given tax-free status to pension funds and insurance companies and other long-term investors like sovereign wealth funds. So relatively, India was looking less competitive, less attractive from a financially risk-adjusted rate of return point of view. So our argument was that for India to achieve its dream of reaching a 5 trillion economy in the next 5 years, and also of building the kind of GDP growth, which, as you all know, has not been what it was projected to be, we needed to get greater capital formation and to contribute towards that GDP growth. So this is really the long-term underlying nature of the economy. And this is really, I think, where infrastructure can play a very important role. On real estate, it's interesting, but the Indian government came out with a target of housing for all by 2022, which is just around the corner. And there have been a lot of incentives that have been put in place to encourage, especially what we call affordable housing. So on the residential side, in the affordable housing category, there is, again, reason to look at investments, especially if you're a long-term investor, And RERA, the Real Estate Regulatory Act, actually fixes a lot of the traditional problems that the real estate sector in India faced. The third one I would say is logistics, and even though in COVID times mobility has been restricted, but it is again so essential, especially as we see the changes in supply chain, as we see some shift of manufacturing coming to countries like India for diversification of sources of supply. There is again opportunity on the logistics side that we see. And of course, the most obvious, which Professor Pauline also mentioned, is the technology and tech-enabled services. So this is something that CDPQ had been looking at even before COVID. So we had actually studied our portfolio to see where our incumbents would be disrupted because of technology. A very, very interesting exercise where our partners like Mr. Nandan Nilekani actually contributed in an amazing way to help us analyze where our portfolio could be at risk. And then on the other side, the opportunity, the more offensive. And traditionally, we have, as conservative investors, we have not been on the bandwagon of the big technology companies. And as Professor Pauline said, that is, coming to bite us at this point in time. But it's not that we are not aware. We were very much aware, and even before COVID, the discussions in terms of how do we really prepare ourselves both on the offensive as well as prepare our investee companies on the defensive side, that had started. So now with COVID, that trend has been accelerated very visibly. But again, I think we have to really look at it as long-term investors, not jump on to the bandwagon blindly. Where we see a sweet spot is where technology and consumption comes together, especially in economies like China, India, the more high population, high consumption economies. So I'll stop there. I don't know if I answered your question.
Sure. Thank you very much. Maybe I'll ask Pauline, given that some of the smaller funds are not able to directly invest, and some don't even actually understand the opportunities of a place like India, how do we actually encourage them by the lead, by watching or following the lead of our great institutional investors like Cdpq, in terms of actually getting involved and participating in what will be the largest growth economy in the world over the next 2 decades?
Yeah, thank you for that question, Victor. Ideas have been, suggested, and I don't know, for example, the, Cdpq and the bigger plans in Canada, one idea, I don't know if it's actually happened yet. I think Anita, maybe you could chime in, is for smaller plans to become co-investor with the bigger plans. So that they essentially act as, for example, infrastructure project managers, and then smaller funds would contribute, part of the allocation to the bigger plans and be part of that. So therefore, instead of giving our money to, Fengate or Brookfield Asset Management for the infrastructure fund, our money would go towards Cdpq to be a part of their infrastructure allocation. So that's something that has been suggested, but otherwise definitely it is difficult. There are not a lot of infrastructure managers that we've come across that do solid investments, have a track record of infrastructure investment in developing countries. So, we do try to look at, as many managers as possible, but again, those opportunities are typically very limited to smaller plans.
So Deepak, if you're still on, Mr. Anand, do you have a question for any one of the panelists?
Thank you, Rontu. Dr. Joshi, thank you for inviting me. You know what, I'm listening everything and everybody here, but what I'm more interested is how we can have relationship two-way. COVID has taught us many things, and one of the things which it has taught us is places with low population, better infrastructure, good air, good water are the places where the number of cases are less, health is better. And in other words, I'm trying to sell Canada as a place to live for your global expansion. If you're looking for a global headquarters, I always tell everybody the best place in the world today is called Greater Toronto Area. Why? We have Schulich here, that's one. More than that, we have people from 165 countries, 202 languages. We have Consulate General and High Commissioner of almost every country of the world here, either in Toronto or in Ottawa. So if you're looking for an expansion, CIBC could be a good way, Toronto could be a good way, but we need to look at both ways transaction, and that's what I was talking to Dr. Joshi, something which we could have a focus going forward. So that's why I'm here to promote Ontario, but at the broader base, promote Canada, but more than just saying it, working on a project-based approach where we bring in the actual physical people, bring them to the table and talk about the opportunities, and not just bringing them, for an example, we talk about the food processing. We have 31 million East Indians living outside India. We have about 20 million more South Asians living outside India. So all we put together, there are 50 million South Asians living outside India, could be a food processing. We could cater to them having a plant of whatever the big brands of Dabur or whatever in Ontario and serving the world. And not just serving the world, you have about 200 to 300 million medium class in India. You have about 10 million of high net worth, what you call in India, they can be served as well. So again, I think I'm here to listen today, but I want to be part of the broader conversation where we can talk about these two-way projects together. So back to you, Twin.
Thank you, Deepak. Thank you for your comments. I thought I'll just put across a quick question to Anita. I see a question from Andrew Russell. How do you see ESG integration and socially responsible investing develop given our experience last year? And he touches upon the backlash against ESG recently by the US Department of Labor, which apparently proposed a rule undermining ESG and forcing funds to focus solely on financial returns. A quick response from you, Anita.
Okay, to whoever that was in the US, I would say if you're a smart investor, you would be looking at ESG from a financial returns point of view. And I don't see a trade-off at all. But I think, you're being very short-term if you ignore ESG and think that you'll come out at the end of the line doing well financially. It's been proven again and again not to be true. And most of us who are long-term investors have really realized that. Our challenge is, how do we create the benchmarks? How do we monitor whether the ESG standards that we seek are going to be there and implemented on the ground across the different geographies that we invest in? And that's why we started, if you remember the PRI, the Principles of Responsible Investment, Cdpq was a pioneer in that movement. And it was in many ways, yes, something that we were doing collectively for the world, but also for our own investment, creating those benchmarks and standards. Similarly, the commitments we are making through the Investor Leadership Network or through the Net Zero Alliance, I think is all going towards articulating, making ourselves open to being measured and monitored by third parties, and really, as they say, putting our money where our mouth is and saying that we will support sustainability. And if you look at, I always say, follow the money. And when you look at large pools of capital, whether it's $6 trillion that a BlackRock is managing, or the $6 trillion that collectively the investor leadership network has under management, all of us are saying the same thing, that we need to focus on sustainable investments, because the risks, if we ignore sustainability, are far, far greater than the financial cost of taking that into account.
Thank you. There's a quick question, and I'll just load on another question I had. Jennifer Fang had a question on how, Anita, to you, how do you select a local GP, particularly in PE investments? And what I'd like to ask you also is, what are, as a follow-up, what are the competitive advantages you feel India-based GPs have to offer compared to global managers?
Thank you for that question, Jennifer. So I would say the process of evolution, something like what Professor Nolan was referring to, which is, you know, all of us started out more conservative, so going with GPs who were international. So KKR, Robert Pincus, TPG, those we are familiar with and those we know from home. Then we have gone into a stage, and this is hand in hand with our local teams being based locally, and also us being able to have the confidence to do direct investments. In some ways, selecting local GPs is part of that whole evolution. And the advantages that we see is, one, they are local, so they know, they have a pulse on what is happening in the market. They can react much faster, and they tend to be more nimble, I would say. The second is that they are addressing a set of companies or opportunities that we either through our direct investments or through the larger funds, we don't address. So very interesting entrepreneurial companies which these local GPs can back. And we, through our co-investments alongside these GPs, actually get an opportunity to invest in those smaller companies with a smaller ticket size, which otherwise typically in our direct investments we could not do. A third, and I think this is the most important area, which is that, you know, many sectors in each of our economies are different. There's no sort of one size fits all. So let me talk about retail. Retail in India with the small kirana stores, etc., is very different from, say, retail in Shanghai or even retail in Sao Paulo. So by working with these local GPs, we've been able to learn from them, understand how the retail sector in that very local setup works. And these are some of the investments that are giving us our best returns, because we are going in more at an early stage, more in sectors that are really high growth, but alongside a local GP who knows the market very well, and more importantly, who knows the mid-size founders and developers, their integrity, their business practices very well. The third area, and I will mention Fundamentum again, like tech-enabled services. So having somebody like Anandan Nilekani and Sanjeev Agarwal, both of whom in their different spheres have really invested and know a lot about tech, as well as the business models behind tech-enabled services. And it's amazing to see how the two come together, and we are beneficiaries. We have a $20 million investment, but I say that we've gained at least $40 million of value from that partnership and that association. So for us, local GPs, very, very important. We do the same in other countries as well, in China, in Mexico, in Brazil. And one point I'll just take to the point that Professor Nolan, Chum Nolan mentioned, of the smaller pension funds. So something we've done, Professor, in Mexico, for example, we've partnered with the 6 local pension funds and created an infrastructure platform where jointly we invest in infrastructure projects. So they learn from us in terms of due diligence of large infrastructure project. We learn from them in terms of local regulations, sponsors, and all the rest of it. And it's a very nice way of coming together. So we would really welcome the opportunity to see how we can better work together, the bigger and the smaller pension funds of Canada.
Thank you, Anita. Ashwin?
Just by way of wrapping up, this has been tremendous. Pauline, you have 2 new fans, so I just wanted to acknowledge that both of them have indicated that they will be taking your class as soon as they can. Hongzu from Shanghai and Kashish Parikh, not sure where Kashish is located currently, but there you go. And there was also a question for you, Pauline, and I guess it relates to this theme around ESG. Around what is the process for assessing business ethics and reputation risk-related issues when you make investment decisions?
Right. So first of all, shout out to Kashish. He was in my class in the winter. We finished on Zoom. So when we select, for example, in equity, our managers very carefully. There's a lot of due diligence that's being done before we make an allocation to a manager, and we diversify across managers as well. So typically their process right now in the marketplace. So again, this is a big change from just even 5 years ago when you talk to these professional money managers. When you ask them in the RFP for the ESG philosophy, they always now have a lot to say because they realize that institutional investors are demanding to understand their process, just like Ashwin, you said, how they integrate ESG into their process. So a lot of them are relying on ESG data. So there's proliferation of ESG rating systems. So the bigger ones would be MISG BARA, and then in Canada, we have Sustainalytics, which has been purchased by Morningstar. But now there's a lot more. So in the technology field, in fintech, for example, there's a lot of companies that are rating ESG for specific equity names, companies, because if you think about MISG BARA, their ratings on Tesla versus Sustainalytics, they don't agree at all. In fact, it's very well known that if you look at a correlation between MISG BARA ratings, ESG ratings, and Sustainalytics, the correlation is only around 0.33. So there's a lot of disagreement amongst the ESG rating providers on, ESG, I guess, impact. So I think what we looked at is, again, it has to be a sound investment philosophy. And then the integration of ESG is part of, so the way that we've been looking at it at York University is part of the many factors that we looked at. So currently we don't have an investment on an ESG specific fund, but we try to integrate ESG as a factor into everything that we invest in as part of the process, rather than for example, for retail investors, you can buy ESG specific ETF or mutual funds, those thematic investment. So we don't look at ESG as a thematic investment. We try to apply ESG across the entire portfolio.
That's very helpful. Thanks, Pauline. Anita, a couple of comments here. Your description of India has been described as measured. So that's, I guess that's praise, that very balanced assessment. And another individual has asked me to wish you, and I'm remiss in this, has asked me to wish you a very happy Onam, and says that despite all of the festivities in the household, the fact that you've taken the time to be with us is indeed something to be called out and explicitly appreciated, given the importance of this festival in Malayali households and in India generally. Yeah. So it's a happy Onam to you on behalf of all of us, Anita, and indeed to all of those who are celebrating. Wish you much happiness today. So
actually, Onam is a festival of hope and of the well-being of the people in every land, right? So I think a very appropriate one, given what we've been talking of and in these COVID times. So I wish everybody a very, very happy Onam.
Lovely. Thank you so much. And thank you all for making this such a dynamic session. As I said, there are some questions here. Pauline and Anita, we will be circulating them to you for further engagement. Thank you all very much for attending, and wish you a great rest of the day, however long it is, depending on where you are. Signing off. Thank you.